back in person, and we have a great topic today on the Fed balance sheet. But before we get started, I want to just do a few logistics. First of all, I'm really glad to see people show up. I was hoping to rent out Fenway Park because I knew thousands would be interested in this topic. But we're all slowly getting back to being in person. The one thing we have discovered in terms of getting people in person is to make sure we feed you. So there's food in the back of the room. Those of you who are listening in will have to bring your own food. But afterwards, we also will have a reception with more food, but more importantly, a chance to talk to the panelists and to mingle and ask questions back then. So that will be after the talk. I said this is our first talk, but if it's a first, you have to have already planned a second. May 2nd, Monday, May 2nd at 4:45 p.m. over in Building 2. That's the math department, for those of you who know MIT well. Room 190, we're going to have a symposium on climate disclosure and the SEC standards mandating publicly traded companies disclose more about their carbon footprint. So I would encourage you, and we will have food for that too. So I encourage you to come, and those of you who are listening and on the live stream to come in person on Monday, the 2nd of May, Building 2, room 190. For those of you who don't know the Golub Center for Finance and Policy, we're approaching our 10th year anniversary. You'll also get invited to that party. The Golub Center its mission is to serve as a catalyst for innovative, cross-disciplinary, and nonpartisan research and educational initiatives that address the unique challenges facing government in their role, both as financial institutions and as regulators of the financial system. It's an important mission, and we strive to do that, as I think you will see by today's panelists, by bringing together academics, public policymakers, and market participants. We encourage you to visit our website. We have a lot of good information, both of past events. For those of you who may remember, Stan Fisher won the Miriam Posen Prize. His lecture is on our website. Again, one of the luminaries of finance honored by the Golub Center. So with that, I really do encourage you to visit, and that we will be doing more of these symposiums. For those of you in Cambridge, we're also on the 13th floor of 1 Broadway just across the street. So we'll be holding events and teas there also. So invite you all to get to know us better. And without further ado, I would like to introduce Eric Rosengren, who is visiting the Golub Center this semester, who will be talking about the Federal Reserve Balance Sheet Symposium. We couldn't have a better person to lead this discussion. Spent many years both heading the Federal Reserve Bank of Boston, and prior to being president, both headed the research function and the supervisory function. So Eric, it's all yours. I'll turn over the podium to you.
Thank you very much, Ed. Thank you for all of you who've come out. And it's really nice to have a conference where people are in person. So it's nice to start seeing this come back. We're already in person in class. So it also certainly makes sense to be in person for some of the conferences and have a chance to talk to people. As Ed highlighted, we have a wonderful panel here today. I'm kind of representing central banking, I guess, as well as my affiliation with MIT. Second is after I give some brief remarks that are going to kind of lay out what was done before with the exit strategy and what's being considered now, I'm going to turn it over to Debbie Lucas. Debbie's going to be representing MIT here. She's a finance professor. I know people in the audience know her quite well. Next, Ajay, who's right next to her, is going to give a market perspective. Ajay is the global chairman of research at Barclays, and batting cleanup is going to be Victoria, who's at the other side of Cambridge, who's at Harvard Business School. and will provide her perspective. She's a real specialist on corporate finance, so we look forward to getting her perspective on that. So let me turn to the exit strategy that was followed last time. The reason that's important is the Fed tends to do policy in rhymes. And by that, I mean that the Fed tries to do something quite similar. It's not exactly the same, but when things work, they don't try to do something completely disruptive. They tend to follow a very similar pattern. And I think it is instructive to see what the pattern was during the last cycle. As we know, that was the cycle that came out of the financial crisis. The financial crisis was a very severe, and as those people that are in the audience that are in my class, when we have banking crises in addition to a recession, they tend to be very long recoveries, and that certainly was the case. You can see that the first hike occurred in 2015, was a 25 basis point increase. And then the increases after that started to be every other meeting. So it was a very gradual increase in the federal funds rate. And roughly a year and a half later, they paused and announced a balance sheet announcement, which I'm going to go over in a minute. But they waited until they got to 100 basis points before they started the exit strategy on the balance sheet. After 6 months, they then resumed tightening 25 basis points at every other meeting. FOMC meetings are 6 times a year, so roughly quarterly. And you see that they stopped at 2.4%, roughly the estimate of the committee's view of what the equilibrium real rate is. Kind of not very tight, but not very easy is kind of how to think about the equilibrium real rate. And I would say that the committee has, if you look at the summary of economic projections, they have roughly the same estimate for what the long run interest rate will be. So they tightened until they got to basically neutral, and then they stopped. The balance sheet continued to be shrunk until 2019. The other thing I would highlight is the tightening cycle started in December 2015 when the unemployment rate was 5%. So the whole exit strategy started a lot earlier. As a result, it could be much more gradual, and that's true for both the federal funds rate as well as for the balance sheet. So turning to the balance sheet announcement, which occurred when the Fed funds rate had gotten to 100 basis points. First, they had a cap, and the idea was that they would allow roll-off of the balance sheet. There are 2 elements to the balance sheet, primarily Treasury securities, for the most part, notes and bonds, and mortgage-backed securities. So for the Treasury securities, they started very gradually, $6 billion a month initially, and then over 12 months got up to $30 billion. So it was a very gradual increase in how much they were allowing to roll off before they allowed $30 billion a month to roll off of Treasury securities. And for the mortgage-backed securities, they started with $4 billion, increased it in 3-month intervals until they got up to $20 billion a month. So in total, they were shrinking the balance sheet by $50 billion a month. So a relatively slow shrinkage of the balance sheet. There were no asset sales, and they focused on making sure that the securities holdings were going to decline in a gradual and predictable manner. So there is a pattern to that exit strategy. First, there was a focus on the federal funds rate as being the primary tool. The Federal Reserve has always highlighted that of the various tools of monetary policy, the one that we have the most experience with is short-term interest rates. And so we tend to focus on the federal funds rate. It increased in a predictable way other than for the balance sheet announcement. And when the interest rate cycle was done, the unemployment rate was roughly 4%. 4% is actually the estimate the committee currently has for what the unemployment rate will be in the long run. That's the median. They did pause when they implemented the balance sheet. They had no asset sales throughout the policy. When you don't have any asset sales, you also don't have any capital losses, because when we do the balance sheet, we do it at book value. So avoiding asset sales also avoids possibly having losses from those asset sales. There were some very key macroeconomic features that allowed that to go so slowly. One was the unemployment rate was declining very gradually over this period. Part of that was the severity of the recession and the fact that it was taking so long to get to the recovery. As I mentioned, the first tightening was at 5%, so it was well above the 4% level. A very different inflation problem in that environment. We were worried about not getting to 2% as opposed to being well above 2%. We didn't have some of the geopolitical issues that are currently being experienced with Russia and the Ukraine. And we certainly didn't have the kind of supply shocks and issues that we've had with COVID over the last 2 years. So there were a number of features that enabled the FOMC to operate in a much more gradual method. So fortunately for this discussion, the FOMC has already given kind of a preview of what they were thinking about. So at the last meeting, which was in March, the minutes actually provided some details about what they were thinking about. And the other reason why it's important to actually have this discussion today is that they're probably going to be making a decision at the next meeting, which is in 2 weeks. So this is an appropriate time to be thinking about it. A lot of the press really focuses on the federal funds rate, but I would argue that the balance sheet is an important tool of the Federal Reserve and is something that people should focus on as well. It follows a very similar pattern to what was done the last time, but on a much more expedited fashion. So the taper, instead of occurring over a year, is occurring over 3 months. The amount of the tapering or the amount of the reduction in the balance sheet is roughly double that of the previous time. Now, the balance sheet is much larger. We have a $9 trillion balance sheet, so they need to bring it down quite a bit more than it currently is. And the cap that they have for the Treasury securities is $60 billion. And to the extent that enough Treasury notes and bonds don't roll off, they're going to use some of the Treasury bills to reduce it up to the cap. For the mortgage-backed securities, there are 2.7 trillion roughly of mortgage-backed securities on the Federal Reserve's balance sheet. And once they get through the ramp up, that's going to be $35 billion per month. So a $95 billion shrinkage per month once we've gotten through the tapering. Once again, they've highlighted that they're not focused on asset sales, but they don't rule out asset sales after the exit is well underway. So an important question for this panel and for thinking about monetary policy is they've given us a preview of what they're thinking about, but is that the optimal exit strategy? So a couple of things to think about. First, the economic conditions are quite different. So as you can see, PCE inflation of 6.4%, CPI is at 8.5%. The Fed tends to focus on the PCE, but regardless of which number you look at, they're well above 2%. So it is unusual to be this far away on our inflation target on the upside. So it does highlight that there is a reason for a much more expedited exit strategy. The second element that's kind of interesting is they're already below what they expect to be the long run unemployment rate for the economy. So the long run unemployment in the SEP was 4%. We're currently at 3.6%. So arguably we're already past full employment. So if you're trying to bring inflation down, it's certainly going to be more difficult if labor markets are extremely tight. And if you believe many of the private sector forecasts, we're likely to grow higher than potential, which means that 3.6% is unlikely to be the low point for the unemployment rate. So the first question is really, is the exit strategy appropriate? Certainly the economic conditions would warrant a faster exit, but an important question is, what are the risks? So we're both raising the federal funds rate quite quickly at the same time that we're shrinking the balance sheet quite quickly if they follow what was laid out in the FOMC minutes. And in particular, a number of FOMC speakers have focused on trying to get to neutral by the end of the year. So rather than taking 3 years, they're talking about doing it in less than a year. So it's a much sharper increase in the federal funds rate. That would be consistent with 250 basis point increases and then 25 basis points at each of the subsequent meetings till the end of the year. So that would be a pretty quick tightening of the federal funds rate. at the same time that we're reducing the balance sheet much more quickly than before. So the question is, what kind of risks could that incur? The second question is, if what we're trying to do is bring inflation down, should we be thinking about which areas of the balance sheet might be more important? And so if you think about mortgage-backed securities, one of the purposes of purchasing mortgage-backed securities is to lower the long-term interest rate. And by lowering the long-term interest rate, you're trying to get people to purchase things that you borrow money for at the long end of the market. So that would be housing, that would be cars, for example. So to the extent that we're keeping an inflated amount of mortgage-backed securities, you're probably not relieving some of the stresses that we're seeing in terms of price increases in things like autos and housing. And arguably, housing has been growing quite rapidly and is an important component of both the PCE and the CPI inflation measures. So an important question is the cap for mortgage-backed securities appropriate? And maybe even more important, given the fact that interest rates have risen pretty quickly and may very well continue to rise over the course of this year, the prepayments on the mortgage-backed securities are likely to be quite slow, so that the caps that they're laying out probably won't be hit. So is there an argument for having a floor on mortgage-backed securities that involve actual sales? And I just throw out as a possibility to have a floor of at least $20 billion a month in sales in those months where prepayments result in not very many mortgage-backed securities being redeemed. We should also ask ourselves, did the cessation of the purchases and the reduction of the balance sheet, would it have been much better off if it had occurred sooner? So by waiting as long as the FOMC has, it has meant that they've had to follow a much more rapid pace on both the balance sheet and the federal funds rate. That obviously has risks when you do it quickly rather than slowly. And finally, when we went into March of 2020, we very quickly took duration out of the market by buying long-term securities, both mortgage-backed securities and treasury securities. But the exit strategy is quite different. We're not actually trying to alter duration very much because we're just allowing roll-off to occur. So is that asymmetry a feature that's a positive, or is that kind of a bug? So with that, I will now turn to Debbie. She looked like she had at least one question on that, so we'll have an opportunity to go back and forth after each speaker has had a chance to talk. So, Debbie?
Okay, you can be talking. I just need to set up for a second. Okay, good. Okay, well, thank you all very much for coming, and thank you, Eric, for those great introductory comments. I thought what I would do with my time was to try to give a little bit of a longer term perspective on the Fed's balance sheet and talk about some of the perhaps larger, almost philosophical issues that we like to debate in the hallways and elsewhere on the size of the balance sheet and what's appropriate. So let me just start, if my computer will move, by saying that, you know, we're focused on now, and now is a situation with this $9 trillion Fed balance sheet. But historically, the Fed kept a very small balance sheet. And in fact, it only started to get large as a response to the 2008 financial crisis and Great Recession and all of that. So, you know, it was considered very unconventional monetary policy to increase the size of the balance sheet at that time. But I think people thought, well, you know, we have to do something because we have the Great Recession. It's the worst economic crisis we've had for ages. Rates are low. The Fed can't really do much. And so there was this idea that we could try quantitative easing, and that was what grew the balance sheet. And so many of us, and I would argue even many people at the Fed, expected that that was really a temporary situation, and that by 2010, 11, when the economy was basically, you could argue, in decent shape again, the Fed would have started to roll off what they had on the balance sheet. But in fact, they didn't. If you look at this graph, and I think it's probably hard for you to see the dates, but well past 2011 or 2012, the Fed continued to grow the balance sheet, and then it kind of leveled out pre-COVID. And then, of course, the response to COVID and the recession was to just ramp it up beyond anything we even saw in the financial crisis. And so certainly the current size of the balance sheet is unconventional. And I think because a lot of people who are listening are younger, I mean, this is really an extraordinary situation. So I think it's important context for what we're talking about here. And you can ignore this graph. It's just a kind of a snapshot between 2008, again, of the total balance sheet. What I actually had before was just the Treasury holdings on the balance sheet. But something else that changed markedly in the 2008 crisis was, in fact, the Fed starting to buy mortgage-backed securities, these agency mortgage-backed securities. And then in the recent COVID crisis, they also bought, very limited, but they did buy some debt of private corporations and companies. And so I would say that this is also another aspect of the balance sheet that's very heavily debated, which is how appropriate it is for the central bank to be buying securities that are helpful to a particular sector. So I think Eric mentioned, we might be thinking about wanting to encourage or discourage purchases like houses at the longer end of the yield curve. And, the question that immediately came to mind that Eric can answer later is, why in the world is the Fed trying to influence what people buy? They have a mandate, which is long run, which is price stability and unemployment, but certainly not the kind of the details of the composition of purchases. So we can talk about that more. But okay, so another issue I wanted to bring up is that there's a stock and a flow aspect to all of this. And on the flow side of things, is the Fed has been very heavily involved in the Treasury market, particularly in the COVID crisis. And what this graph is showing is the net issuance of Treasury securities by the Treasury and the Fed purchases at the same time. And basically the Fed recently has been buying more than 100% of what the Treasury has been issuing. And so I think there's just some questions about, that kind of balance sheet accumulation, which have to do with, well, is the large Fed footprint exacerbating liquidity problems in the Treasury market? And ultimately, how much is that costing the Treasury and costing taxpayers? Because I just want to note that the US has 22 trillion in government debt outstanding. So if you do the math, if the actions that the Fed takes increases the cost of the federal debt by 1 basis point, 1/100%, it increases the costs in a year by $1 billion. So, it's a lot. This is small changes in rates make a big difference on the fiscal side. So this is getting perhaps, I hesitated before showing this slide, but I couldn't help myself. So you don't have to pay attention to the details, but what I'm trying to show here is that people get very confused when we talk about the Fed and how they stand relative to the rest of the government. So, we have monetary policy in the Fed, but we also have fiscal policy in the Treasury, and the government owns a lot of things. And so it's helpful sometimes in thinking about what the Fed is doing to actually think about what I would call a consolidated government balance sheet perspective. And the bottom line of a consolidated balance sheet perspective and the growth of the Fed balance sheet is really what has happened is there's been what you could call a liability swap. That is, the government collectively has replaced Treasury securities, longer-term Treasury securities that the public is holding with reserves that banks are holding. So as Eric said, it's really shortened the term structure of liabilities. And so as a first approximation, I will say that really means that what they did doesn't matter because the total liabilities haven't been changed from a consolidated government balance sheet, but it does make a difference to what's outstanding and potentially the cost of funding that debt. And I'll talk more about that in a minute. Okay, so this slide has a lot on it, and I was hoping someone should give me discipline. I'm going to give myself discipline. I'm not going to talk for much longer. Okay, so I think, when we think about why did the Fed decide that they love having a large balance sheet when they first started, they didn't think they were going to maintain it. So something I think it's also important for you to understand is the reason they were able to do it in the first place is that in 2008, among the many pieces of legislation that affected the Fed and what they could do, there was a change that allowed them to pay interest on reserves. And that gave the Fed a new and very powerful tool. And in fact, they wouldn't have such a large balance sheet if they couldn't pay interest on reserves, because the only way they can get money to buy those Treasury securities is to get the money from the banking system. So they have to pay the banks enough to be willing to provide the funds, and so they can buy the reserves. So that they were empowered by this increase in power through the ability to pay interest on reserves. And they like it because it avoids the zero lower bound on the yield curve. And I think now I was talking to Eric about this the other day, the Fed, I think, has moved to a philosophy of wanting ample reserves. And by ample reserves, I think they mean they want to make sure that there's plenty of liquidity in the banking system so that banks aren't going to run into some kind of a liquidity crisis. See, AJ's nodding his head. Okay, so that's what's good about it from the Fed's perspective. I think the short run concerns that will come up on this panel have to do with flows. Is the Fed going to disrupt the market by drawing down the balance sheet too quickly, or what's going to happen there? But I really want to focus on some broader concerns, which I've been kind of alluding to. And part of it is the hidden fiscal costs of having a large balance sheet. And there is no time for this, but I'm just going to say that what we have now is because the Fed is paying an administratively set interest rate on these excess reserves, we've moved a ton of market determined interest rates to the Federal Reserve. And so the Federal Reserve, by my calculations, has been paying an above market rate on those reserves. Evidence of that is that other companies have piled into banks to try to take advantage of the Fed offering a relatively generous rate. And then more of my back of the envelope calculations said, well, that probably cost taxpayers about $30 billion. But beyond that, so there's this kind of fiscal policy concern. But I think the biggest concern, and something we can discuss, is how much economic power really should be delegated to unelected officials, because this really gives the Fed a lot of leeway. Is it okay for them to be holding private securities? Is it industrial policy? Does that really belong in Congress? And then even people who want the Fed to have a lot of power have to be concerned that ultimately the Fed's independence will be threatened if they try to do a lot and they fail. And so it's just a consideration of whether such a large balance sheet and so much power is useful to them. So I'm going to end by just saying that one of my favorite books for decades is by Paul Tucker, who is often at the Kennedy School, and he was high official at the Bank of England, among other things. He wrote this book called Unelected Power, The Quest for Legitimacy in Central Banking and the Regulatory State. It's just an awesome book. So if you're interested in these issues of, what should so-called independent agencies be able to do and what are the costs and benefits, I recommend that to you. So thank you.
I just wave my hands really often. So I just wanted to put numbers on the table in term as a market participant. First, I should say that the detail with which the last minutes laid out a supposed path does mean to most of us, most of the investors that I talk to, most analysts in the market, that that is basically going to be the path that the Fed follows. That means in 2022, about $580 billion rolls off in treasuries and mortgages together. And the thing is, it's not that hard to come up with even the mortgage numbers, just because interest rates have sold off so much. The mortgage universe as a whole is significantly enough out of the money that, you know, there's a fair deal of certainty about even mortgage cash flows. Next year at the same pace, about 950 billion, 650 in treasuries, another 300 odd billion in mortgages. The year after, 2024, another 950 billion. The year after, as the percentage of the balance sheet starts to go down, the caps are increasingly not hit. So in 2025, about 750 billion. So just to put it together, say the Fed continues on this path until the end of 2025, you're looking at the Fed's balance sheet coming down by about $3.3 trillion. We go back to a little below 20% of GDP as the Fed's, you know, the Fed's balance sheet by the end of 2025 ends up being a little below 20% of GDP. Now, could they have been more aggressive? Medium term, with the exception of immediate asset sales, it's hard to see how, as Professor Rosengren made the point, on the mortgage side, 35 billion from the start, the minute the numbers came out, we all looked at each other and said, this is, why would you put 35 billion? There is not a chance in hell that those caps are going to be hit most months. And immediately the thought process was, the only reason is because at some point they plan to put a floor in, you know, and say a 20 or a $25 billion floor per month. But otherwise 35 billion is not going to be hit. So if they are uncapped, the pace at which things roll off, it's not clear that the numbers, you know, would have been much larger. There is one way in which they could have been more aggressive, and that is bills. And that is near term. So the US Central Bank has about $260 billion of bills. You could argue that they could have treated bills differently than coupons, just let them roll off. Most of them are below 6 months. So 260 billion in bills rolls off by the end of the year, and another 550 billion or so in treasuries and mortgages roll off. And they didn't do that. So near term, there was one particular nuance that they missed, but you know, longer term, it doesn't change the picture. The big question that I keep getting is, can the market digest this? And you know, the funny thing is, what the Fed is allowing to roll off is only one side of the equation. The other side of the equation obviously is treasury issuance, which, believe it or not, relative to 2021 is falling off a cliff. And the reason it is doing that is because US taxes are pro-cyclical. Every single time in a recovery, the CBO ends up underestimating the extent to which the deficit will come off. This time, even more so, because tax receipts are nominal in nature. Last year was a good growth year. The US economy grew at 5.5–6% real. Inflation was fairly high. This year, you know what? Even as the US economy slows down a lot in real terms, nominal GDP growth is not going to slow down. You could argue that it ends up being, I mean, put a number to it, right? Say Q4 over Q4, the US grows in 2022 at 2.5%, which is right in the middle of consensus forecasts. Inflation averages 5.5 to 6% a year. The US economy grows at 8 to 9% nominal. Tax receipts this year, tax receipts next year, assuming you know the current pace goes, and because Congress can't agree on anything at this point, right? So the chances of new fiscal stimulus are very, very low. That means that Treasury's issuance is falling off a cliff next year. So even with, so I'll tell you what our numbers are. Next year, we expect the US Central Bank to allow about $600 to $650 billion of treasuries to roll off, which have to be absorbed by the private market. Beyond that, coupon issuance away from that, from the treasury side, will be another 550 to 600 billion. That number sounds very, very low. But part of the reason why it's low is because, like I said, deficits are coming off. The CBO's deficit projection is 800 billion. And remember, part of that is because bill share is going up. Everything we are talking about in terms of the private market needing to absorb supply is about coupons. So in 2021, even with the Fed buying as much as it was, the amount of coupons that the private sector had to absorb was 1.8 trillion. 2023, that number will be about 1.2 to 1.3 trillion. So that's the second point that I'm assuming that outright asset sales are not in the picture. And I do think that at least for 22, they are not in the picture. This is an incremental institution. It doesn't make rapid moves. And it doesn't say, go against things that they have themselves said. I mean, look at Chairman Powell's statements. We'll go much faster than in past cycles, but with substantially the same measures that we have taken before. That in my mind means that near-term asset sales are out of the picture. I guess the third question is, how does the central bank think about asset roll-off in terms of what it means what is the equivalent in terms of the policy rate? And the short answer is we do not know, and the central bank doesn't know. Way back when, about 15 years ago, when the first big rounds of QE started, at that point, and Professor Rosenberg, you probably remember this, there was a rule of thumb that New York President Dudley was fond of, about $1 trillion in balance sheet expansion is worth about anywhere between 30 to 50 basis points in reduction on the policy rate after you've hit the lower bound. What we have observed is that long run rates typically go up by about 3 to 4 basis points for every 1% as a share of GDP reduction in the Fed's balance sheet. Now, there's not a whole lot of examples, admittedly, so this is a guesstimate, but we are a $22 trillion economy. So every time the balance sheet goes down by 220 billion, the long run rate, everything else the same, goes up about 3 to 4 basis points. If it goes down by $1 trillion, then the balance sheet goes, if the balance sheet goes down by $1 trillion, the long run rate, all else equal, ends up going up about 12 to 15 basis points. Right now, there are some indications about what the Fed thinks about this. So Chair Powell came out a couple of weeks ago and said that we think that the balance sheet reduction that we are looking at is probably worth 1 rate hike. The problem is, a few days after that, Governor Brainerd came out and said, well, it might be worth 2 to 3 rate hikes. For those of you who follow markets closely, one of the surprising things over the last 3 to 4 weeks is that US yield curves have stopped flattening and have started steepening hard. And part of the reason is because markets seem to be coming to the conclusion that the Fed will depend more on the balance sheet, or will count more rate hikes associated with the balance sheet than they were previously doing, which means that they will end up doing net fewer rate hikes in general. And I mean, look at longer term break-evens. This is not about more asset sales that the market is worried about. This is about the market being worried that the Fed will not hike enough to get medium-term inflation under control. And then finally, what was the experience of last time? There has been a previous QT episode, if you guys remember. October of 2017, the Fed starts QT. It continues and into 2019. Now, of course, they moved away from the rate hike cycle at the end of 2018, and then in the second half of 19, they were aggressively cutting interest rates. But in the first half of the QT cycle that preceded this one, 10-year Treasury yields sold off aggressively. Now, you could draw a straight line between that and what the Fed was doing on the balance sheet, except guess what else went up at that point is most people's GDP forecasts. And then in the second half of 2018, even as QT continued, 10-year Treasury yields started rallying hard. And guess what else came down at that point? Consensus GDP forecast. So remember, it came down to the point where by early 2019, the Fed did a massive about turn. In late 2018, December 2018, the Fed hikes without a dissent, even as there is a big risk of happening in financial markets. And then they turn on a dime in early 2019. And QT was continuing all through. Part of the point I'm making is that longer interest rates are far more hostage to markets' belief about where the medium-term path of the policy rate is going, as opposed to what is happening on the balance sheet. The taper tantrum. Do you guys remember the taper tantrum? A bunch of you are not in markets at that point, but for those of you who you were, who you were in the markets, right? In May of 2013, the FOMC minutes come out and the taper tantrum starts. The June FOMC meeting adds to it. 10-year treasuries go from 160 to 320. And remember, the catalyst seemed to be that the US central bank would pause asset purchases more quickly than the market expected. The funny thing is the 4-year point also sold off hard, but that didn't make sense. By then, if you remember, Operation Twist was in effect. It mattered enormously to the long bond, whether the Fed would continue purchasing at the same pace or not. If that was the only thing that mattered, then the 4-year point, the 3-year point really shouldn't have been impacted. The reason it was is because the markets said that an earlier than expected end to asset purchases is a precursor to an eventual earlier than expected start to the hiking cycle. And that's when things took off. There is a link. The 10-year, I keep getting asked, what is the fair value of the 10-year treasury? When you ask me that, you're asking me two separate questions. One is less important. That less important question is, where is term premia in the 10-year over the medium term? And the term premia is a garbage bag. Term premia includes the risk that the central bank falls behind the inflation curve. It also includes the risk that there is a sudden exogenous supply of bonds. Okay, term premia is like credit spreads, like option adjusted spreads. But the more important question that you're asking me, by far, because all rates are bootstrapped, right? The 10-year is the average of the short rate over the next 10 years, plus some term premium. The short rate in the United States happens to be the Fed funds rate. So the real question you're asking me is, what is the market's expectation of the path of funds over the next decade? And that expectation changing one side or other is what drives longer interest rates far more than what the US central bank does on the balance sheet. Everything else the same. So I'll stop here and I'll hand it over to Victoria. Thank you.
I'm gonna return to the question of whether the strategy for runoff of the balance sheet of the Fed is optimal or whether there is something to be done differently. And of course, as Eric emphasized, many of the points in the current strategy are based off the experience of 2017, 2019 runoff. And on top of that, as several other speakers already mentioned, the starting from the point where the runoff is already more aggressive, precisely because 2017, 2019, despite the volatility towards the end of this program, is considered to be a success, there is a bigger confidence as well as a bigger pressure of undertaking this policy step at a faster pace right now. However, we should ask ourselves, why is it that the initial runoff strategy in 2017, 2019 had all those cautious elements that we kind of carried into today? And that will be part of the answer of how aggressively we can go. Do we want, yet again, to reiterate, there is already a sooner, faster, and potentially sales on the background, which is a new element that is being incorporated. The reason for 2017, 2019, the cautious approach was because we don't have much experience with this. And we do believe that there is an interconnection between the financial markets and the stability of financial markets and this tool with which Fed has less experience. So now we have to ask ourselves, how much confidence did we gain in 2017, 2019 to be able to say business as usual? We've learned a lot and we carry it forward. And I think that first point here is that just kind of grasp the complexity of a lot of the things that we are dealing with here. And for example, Ajay was emphasizing, thinking about treasuries. He was saying, well, one thing that Fed does not control the supply of treasuries. So that's one moving piece on the background. If you think about MBS, there is a credit risk, there is a repayment risk, which move independently. And you've seen the rise in the spread in MBS before the QE starts. So clearly those can move independently, and their connection with the policy is something that needs to be pinned down. Furthermore, you can think about, well, actually, there are cross-sectional differences in the way these policies can have on the banks. There is additional evidence that there are local effects and demand for particular maturity of the treasuries and MBS. So all that bundle kind of moving and interacting with itself creates this complexity that is not to be taken for granted. Now, moving that piece aside, and again, so I think that I'm arguing for there is a good reason for being cautious the first time around the experience was very useful. We've learned a lot. To add to other things that we didn't mention, for example, towards the end of 2019, one of the issues when there was market volatility, the senior loan officer survey incorporated a question about the level of necessary reserves. And so this is another kind of measure of the market. So there's definitely been learnings that will be helpful in today's context. But putting aside complexity, I think there is another element that is super important, and that is the state of the financial markets more broadly. In my view, in 2000, so another experience that we have this beyond the first wave of the runoff before the COVID is actually the experience with financial markets in 2020. And because it was so brief, we kind of tend to we tend to forget about what it represented, right? So in March of 2020, bond markets were under severe distress. And the only reason why it was relatively brief is because it took in a tremendous government intervention, part of what actually landed on the balance sheet of the Federal Reserve. So precisely, so that moment kind of, in absence of the significant and incredibly sizable intervention of the government, highlights to us that there was something that was off with the mark. Now, I don't want to introduce panic. There are actually a lot of positive things that we learned in 2020, even in absence of the government intervention. And that is, for one, that banking sector was in a shape that is able to withstand significant market instability, right? So that's one point. Another element that actually a lot of the expansion of the high yield debt that happened after the financial crisis happened not through the banking system, but outside of the bank. It's not a very popular term of so-called shadow banking. So actually, a lot of the pockets of that financial markets are not runnable in nature. So when we think about the propagations of the shock between banking sector that is in a better shape and a lot of the pockets of high yield debt being not runnable, those are the positive news. Nevertheless, of course, March of 2020, the disruption in the bond market did happen and did require a very large intervention. And so what was the cause? Well, a lot of the research points to the fact that one unstable piece of this equation continued to be mutual funds, right? And specifically high yield mutual funds. So there have been a lot of research done afterwards, as well as there is a contributing force of the post-financial regulations of the banks that affects the role of the banks in dealing with instability in the fixed income markets. So if you think about a mutual fund as one of the pieces that can be unstable, that is definitely one of the lessons of 2020. Well, it's still there. If you think, there are segments of the high yield mutual fund market, but focusing on the leveraged loan market, for example, the mutual funds are specialized in that asset class. So of course, there was significant outflow after the shock of 2020, but actually the AUM of those funds now is exactly at the same level that it was in 2019. So that segment did not shrink, nor it became tremendously more stable. And in some of my research, we looked at the return of the fund flows in the cross-section of mutual funds. And while there is some differences between those that were more or less affected by liquidity, overall the picture is that money came back. So another element, so this is as far as financial intermediaries and potential instability there and the lessons that we learned in 2020. Another element, of course, is a bigger background of very high corporate leverage and relatedly very high valuations. I actually would be curious to hear about the rest of the panel, but one thing on the background is potential contraction of the stock market and what, if any, propagation effects it might have on the economy. Is it going to be the dot-com bubble-like, or is it something that has another effect? That's a separate question. Now, focusing on the leverage, and again, if you think about, for example, large cap leverage, highly leveraged firms, again, we are zooming on the firms that have the highest level. If you think about 2006 before the financial crisis. The level of debt was 4.4 EBITDA at issuance. Now it is actually 5.6. So right there, tremendous difference. Middle market, very similar numbers. Now, again, the piece of good news is that it's not something that kind of catches fire very quickly and propagates. But the bad news, I do think that we don't fully understand that there are immediate kind of ways in which leverage catches up with us. In 2020, we were talking a lot about the wave of bankruptcies and how that will increase the bankruptcy costs and all of that. Well, actually, even before we get there, the bulk of high yield debt is sitting on a type of contracts that have restricted actions that affect investments, to put it simply. So that is rather immediate. So, and that kind of starts feeding back into how to control inflation while not triggering recession. So while playing with an economy that is highly levered and that is sitting on this type of contract, even outside of potential contagion effects through the financial intermediaries, this is another component to keep in mind. Of course, needless to say, all that is happening in the context of the unusual geopolitical risk that is affecting the volatility in the market. So in sum, I think that the question here, would we do anything different? And I think that in this initial, while some elements of it are more aggressive and understood why, first and foremost, the problems that we're trying to solve is different. We do have some experience, but I would be very cautious in overlooking the fact that we are sitting on a rather fragile financial system that we need to understand more in which it's going to be reacting. Because the last time we had it unstable, it took us doubling the balance sheet of the Fed to be able to fix it. So that's something to keep in mind.
Just to have the mics, I'm the only one who doesn't have So I think we got 4 different perspectives, and that's exactly what we were hoping to get with this panel. I was going to ask a couple of questions and then open it up to the floor. So hopefully this discussion has initiated some questions in your own minds. But first, I want to just start with what the Fed actually put in the minutes. So one way of thinking, normally if you read Fed minutes, they're not that specific normally about what they're going to do. And the way I would interpret that, it was a trial balloon. They wanted to see how the markets reacted. They wanted to hear how much criticism they were going to get. And that would give them some guidance as to whether they had to make some adjustments in time for the next meeting. So I want to ask each of the panelists, we've laid out, they have roughly 3 months of tapering, and then they're going to be doing shrinking around $95 billion if they get to the caps. If you had an opportunity to provide advice to the committee, what would that advice be? And I'll start with Debbie and we'll go down, and then I'm both a panelist and a moderator, so I'm going to kibitz a little bit at the end, but I'll start with Debbie.
Okay. Well, my advice would be to focus less on the short run and set out more of a longer run vision for where they want the balance sheet to be and why. I know it's something they get pressured on all the time and haven't been willing to say. I also don't think that asset sales should be off the table. As my comments probably suggested, I think it should be a priority for the Fed to go back to relying less on a balance sheet policy, because I do think it's too aggressive. I think what they really have is a dynamic control problem. And the question is, what do you say to the markets, which gives them enough flexibility to pull back if they feel like they're having more effect than they anticipated. Certainly, we don't want another taper tantrum. But I think it's important to lay out a long-term goal and to be open to trying to reduce the size of the balance sheet with an eye towards what it's causing and the ability to kind of slow down it when it seems warranted. And I think the communication problem, is always a challenge for the Fed, but to somehow leave themselves flexibility, but to be more explicit about what they're ultimately trying to achieve beyond the current concern about, is the inflation rate too high and what are we going to do about it?
I would say, sorry.
Go ahead, I'm done.
I would say pretty much the same. One is what their endpoint is. So just as a thought exercise, 12 months from now, the US goes into a recession. Western consumers are totally taking it on the chin right now, in terms of for real disposable household incomes being hit badly. And just for argument's sake, we do not dip into our pool of excess savings to anywhere near the extent that people expect, and consumption slows down a lot. Last year, we pulled forward goods purchases from future years, et cetera, et cetera, et cetera. So the US goes into a recession. We do, in a perfect world, get a massive amount of goods deflation fairly quickly. So, and this is a thought exercise, and it's my thought exercise, so I'm making this up as I go along. But what does the Fed do about the balance sheet? Say it stops on the Fed funds rate, but does it allow balance sheet roll-off to continue? If the recession is severe enough that the US central bank says, well, we might actually have to change direction, then does it allow the balance sheet to continue, or does it stay stuck with a $7.5, $8 trillion balance sheet? The fact is, I don't know. We do not know how they think about the balance sheet as an alternative to rate hikes. The chair says one hike. The vice chair came out and said maybe two or three. I need to know. That's one. And then on the micro side, they do keep hand waving at asset sales. And I understand why. Mortgage cash flows are long. And at some point, if you want to go into a treasury only portfolio, you have to sell your mortgages. But the mortgage market, I think, would like some clarity about what at some point means. I realize that the US central bank needs to preserve flexibility, but does that mean at least that asset sales, mortgage asset sales in 2022 are off the table? And I'm telling you, if that is not the case, the mortgage market is going to be very, very surprised. So it's just, I think there's not enough clarity about how they think about it, and there's not enough clarity about the details, is what I'm saying.
Yes. So Eric, you raised the point about possibly setting a floor on asset sales. So first about, given that there are already several levers that are being tested here, the speed, the when, maybe on the asset sale is something that needs to be taken cautiously and slowly, taking into account AJ's point. And as to a visibility point, which is super important. Of course, the first time around, there was this tremendous focus. It has to be transparent. It has to be perfectly predictable. And so in that sense, you have to think about somehow about asset sales fitting within the same box. And I think that we talked earlier with you about the concern with asset sales is, of course, the fact that you could potentially facing market losses. And so to the degree that the floors are within a range that is not damaging on net, then I think that that's the way to go with predictability of asset sales in the future.
Yeah, and my own viewpoint, we'll get to questions in a minute. My own viewpoint is that this was actually pretty bold. This was bolder than I was expecting the Fed to come out, both in a shortened timetable, and the quantities were a little bit larger than I was anticipating. And I do think that there is some risk to having to do things quickly. So I think particularly as we get into the latter half of the year, the Fed's going to have to be very attentive to whether the combination of rapidly getting to neutral on the Fed funds rate at the same time you're shrinking the balance sheet starts having a market dynamic that they weren't anticipating. We'll see if that happens or not. At the same side, if I were grading this, I'd probably give it a B. And the reason I would give it a B is the assignment was turned in late. And by what I mean by that is that the reason they're having to move so quickly is because they started so late. So if you had started much earlier, you wouldn't have had us in a position where we were exiting on both tools that we have nearly as quickly. And then the second part was an incomplete answer, which I think it would have been better to have more clarity on the MBS. And my own personal preference would be I doubt they'll do anything this year for the reasons that were just highlighted. But I do think that they really should think about making sure there's a minimum floor, because if they don't, we're going to have a lot more MBS for a much longer period of time than I think many people are comfortable with. I'll ask a second question, then I'll turn to the floor and I'll fill in if after that. But my second question is both the last exit strategy and this exit strategy, it started with Fed funds increases and then a change in the balance sheet afterwards. And I'll start with Victoria this time and say, is that the right ordering? And are there times, was this the right time, or are there times when shrinking the balance sheet before raising federal funds rate would be appropriate?
And just to be clear, you already took a stand on that because you said they're too late to winding down the balance sheet. But of course, if you go with rates first, and that kind of changes it. So, I mean, the basic problem is that you want yourself, give yourself some room for contracting something that goes wrong. And so that's always been the reason for, always, in a short history of our experience, that's been the reason for trying to make sure that the rate hikes are on the way before you start dealing with the balance sheet. So I think that it depends on the severity of what one is trying to do. So if you're talking about, you already said that this is aggressive. If you add asset sales to that, then I think that having rate hikes, some room in terms of tools that we understand very well, mostly understand very well, and with which we have experience, that would be the core reason for doing it in that sequence. Forever, I don't know. That's a tricky question.
I would say I agree with the notion that they should have stopped way earlier. I mean, 120 billion was just a lot, month after month after month after month. But the magnitude by which inflation missed forecasts, I mean, remember at the start of 2021, and I'm not knocking the central bank, most of us, myself included, got the magnitude wrong. But the Fed's core PC inflation forecast for 21 was 2%. 2 became 2.4, became 3.4, became 4.5, finished at 4.85 in the same year. That is a very impressive miss, 300 basis points of inflation in the same year. So, if you do that, then I don't think you have the luxury, especially if you are ruling out quick asset sales. I don't think you have the luxury of waiting until the balance sheet is down a certain level before you move on the policy rate. And the fact is, and I keep coming back to this, as a market participant, I understand what Fed hikes mean far more than I understand what a rolling off of the balance sheet means. They needed to move quickly. I would argue that they turned fairly quickly, still perhaps slowly, but they turned fairly quickly on the policy rate. And if that meant that they moved on the policy rate before QT, then that was fine. I think this was an unusual situation. And if you are using the inflation profile from last time, maybe it would have made sense to first, you had time. You could argue, I've been in rooms in the Eccles building, in the boardroom, where the argument has been pre-COVID, that the entire previous hiking cycle was a mistake. Where the hell did we average 2% on core PC inflation? We didn't. In December 2015, when the rate hike cycle started, core PC inflation was 1.5. 2 years into it, in December 17, we were at 1.4. Right? Why was so that was an example where you could have led with the balance sheet and waited on the funds rate. I think this time we needed to move on the funds rate.
Okay. So I'm very uncomfortable with ideas like we're going to trade off 2 rate hikes for X% reduction in the balance sheet. I mean, I don't think we understand that. Let me just start out by saying that macroeconomists have no model in their head for whether quantitative easing, even what it does, the time lags and everything else. So I think there needs to be 2 different policy statements. One is, what is our goal for where we want the balance sheet, like independent of what we want to the inflation employment trade-off in the short run. And then, my preference clearly is to go back to using short-term interest rates as the primary policy signal, because as AJ said, the market kind of, they think they know what it means. I'm not even sure we know what that means, but at least it's, kind of standard monetary policy that we can deal with. So I would rather see the 2 things more clearly separated. And that the interest rate be used as a primary policy tool, and we just go back to the world pretty much before quantitative easing was a thing.
So my own view may be slightly different than Debbie's, and we've had this discussion before. My own view is that both in the financial crisis and then when the pandemic started, there was a strong reason to be doing asset purchases. First of all, the Fed funds got to zero fairly quickly. So we were very far from full employment. There was a risk that inflation could drop too low, and it made sense to use other tools to try to get us back to our dual mandate more quickly. The second element of that was that financial markets were pretty dysfunctional at both times. So in 2008, a lot of things weren't trading, and the purchases by somebody actually started to make a difference. And I think that was important. And I think that's true in the pandemic too. I think I was certainly surprised that both the MBS market and the Treasury market were so dysfunctional in March of 2020. So I think the asset purchases actually played a stabilization role that was really quite critical. But as we got into 2021, we no longer needed to worry about whether markets could efficiently process the securities. And at that point, it was pretty clear that the economy was growing pretty rapidly. So I think this is probably a time when my personal preference would have been probably as we got into the summer of last year to start scaling back on the asset purchases. That would have given us much more flexibility to, or the FOMC to have a lot more flexibility to move a little more slowly and think a little bit differently about the sequencing of the two policy tools they have. So why don't I turn to questions now? And I think I have the mic, so. Okay, thank you.
Thank you. Thank you very much. It's a great event. Amazing. Got greater minds than me. I'll just use the similar framing. So this week is the IMF World Bank spring meetings in DC. So I figured we're talking this internal dynamics. I was wondering if I could ask the panel's opinion on this kind of external dynamics. My understanding is the Fed ends up controlling the money supply, but eventually this trade deficit ends up getting the liquidity back to China. And we have this weird dynamic where China has this global responsibility as the kind of global bank, if you will. And there's also this interesting move of trying to get the pipes to work well. My understanding is Treasuries only clear centrally about 20%. So trying to get central party clearing for all Treasury markets seems like an interesting development. My concrete question would be, any advice to global leaders as these kinds of potentially catastrophic, well, this is a wrong word maybe, sovereign debt defaults from this massive COVID spending comes to bite us in the near future around the world? It seems that everybody is spending quantitative easing here, different countries haven't even vaccinated their own people. So it'd be great to see what this dynamic looks like if we're gonna have to deleverage across the board, not just here. Thank you.
Why don't we take two more questions and then we'll have the panel respond to whatever aspects of the questions that.
Thank you. I think it's a related question. Taper tantrum was mentioned a couple of times, so I'm just wondering whether you think to what extent is the Fed thinking, or should the Fed be thinking about its policies impact ripple effects in the global market, especially given what's happening right now in a geopolitical situation.
Thank you for this wonderful speech, and thanks everyone from the panel. My question is more about the supply side shocks. This current environment reminds me of perhaps in the 70s when we have a commodity shock from OPEC and the oil supply. And right now with the war in Ukraine, potentially food prices can shoot to the roof, and also related to the Russian sanction, that is potentially another shock. We already seen crude oil prices went up to around $100 per barrel. Just wondering how effective the Fed is using their current monetary policies to actually try to counter the high inflation domestically when the shocks are actually coming from a global impact.
You want me, can I start with the third one? Because I forgot the first two. Okay. So, so on the supply side, number one, you're right. The world is facing arguably a second supply side shock. COVID disrupting global supply chains in many ways was the first one. It will have ripple effects. You should be worried about a version of the Arab uprising, which, if you remember, was basically food insecurity related in 2011 and 12 in some of the more vulnerable economies. The problem for the United States is that that is not the only source of US inflation. Energy, energy goods and services, US inflation is still running healthily. The issue with, because I keep getting asked this question, why would the US central bank hike? Does that make ships more likely to move? Does that mean Russia releases more oil? Does that mean Ukraine's plant? No, it doesn't mean any of those things. But what it does mean, the risk is the second order effects, right? The risk is that you and I and everyone else in this room looks at 7% inflation, 8% inflation, throws their hands up and says, I don't care why prices are going up. Everywhere I look, prices are going up. I need to be paid more. And those expectations start to get embedded in an economy. It's very hard to unwind those, right? The US central bank, this year, two things will happen. Inflation will come down significantly from current levels. It almost has to, just because base effects are so strong in the second quarter. And because on the good side, you'll see some deflation. We'll still be well over the Fed's target by the end of the year, but inflation will come down from over 8. March will be the March print, or I think will be the peak. The US central bank will hike aggressively this year, and the two will not have a whole lot to do with each other. But it is a stake in the ground. The Fed has to prevent expectations from running away. And that is the reason why they are, it's a risk management exercise is the way that I would phrase it. And the thing is, at 8% inflation, even if all of it is supply side driven, even if there are 0 second order effects, which side would you err on the side of, right? You would err on the side of, even if there was no localized inflation, which there is, demand driven inflation is a thing in the United States also. It's not so much in Europe, but I just don't see how they can stay on the sidelines, even as they realize that a lot of the inflation they're seeing is supply side.
So, well, I'll use the combination as a segue into something I wanted to talk about anyway, as public speakers often do, which is to say that, fiscal policy was huge during COVID, and it was fiscal policy, it was credit policy. I'm working on a paper with the IMF, which talks about the $5 trillion that economies made available through credit support. So actually, I've defended the Fed on the grounds that we forget so quickly that we just came through this severe crisis, and it was governments, not just monetary, but fiscal. There was just this huge impetus to try to make things better. And that's probably why March of 2020 didn't get worse, is because actually there was all this support, and it wasn't just central banks. And so I think that with that as a backdrop, actually there should be more modesty about what the Fed thinks it does, because there's supply shocks, there's fiscal shocks, there's everything. The Fed can only do so much. And as AJ said, I agree completely. It's like, what do you think half a point in an overnight interest rate really does to the economy? I mean, in my mind, in itself directly, essentially zero, because when companies are deciding whether to borrow or not, they're worried about credit spreads and everything else. And so it's a signaling thing. And so it seems appropriate to signal, but I'm not as critical as the Fed as many others. Like, why did they miss all their forecasts? Well, I think and why did they act so late? I think it's because they couldn't act against fiscal policy while we were in a crisis. And then there was this overhang of all the savings and everything else on top of all the supply shocks. So I think there's a lot of factors that are very complicated. And these kinds of conversations actually just reinforce in my mind how much weight we put on the Fed, which I think is just overplaced. So I'm going to use that as an opportunity to say, we treat it like magic, like the Fed can make something happen. It's like, just tell me the mechanism. But really, the world is a complicated place. And that's why I do think the Fed should have longer term goals and, kind of try to reach them more simply, instead of saying, well, we have to do this because inflation is this, and this is the response we expect. So it seems unrealistic. There you go.
So on the point about the emerging markets and the COVID, so in 2020, towards the end of 2020, I collaborated on a report for G30 on reviving the corporate sector, and there we took a global perspective, and this is one of the points that's was raised in that report, is that it's absolutely it's unambiguous that the emerging markets were disproportionately affected during the COVID. Now, and this is something that, I mean, we've been distracted by so many other things that's been going on, but it is something to think about in the background. And not surprisingly, if you think about, for example, Brazil, a country like Brazil, which is had the second highest rate in the world of people passing away due to COVID, they not surprisingly had also very huge macroeconomic instability. And so this is something on the background that is very important. Now, related to the point of the taper tantrum, and of course, taper tantrum had a lower effect in the US, but the reason you're raising this question is because it had a tremendous impact on a lot of emerging markets. Now, these two questions are related because actually precisely because emerging markets were affected by the COVID so disproportionately that capital outflows that we've so violently seen in 2013 as a result of taper tantrum actually is not going to be, the silver lining of it is that the capital been exiting emerging markets slowly. So perhaps as it's not going to be that strong and pronounced to the effects of the monetary policy effect in this time around. More broadly, however, I think you're raising an important issue about the interconnectedness of the global economy and specifically emerging markets, and it's the usual effect that is out there in the background in absence of additional shocks. As we already said, the COVID here already tamed the international capital flows quite a bit. And so in that context, the reaction is not going to be that large. But more broadly, it is in normal context if the cycle, the interconnection between cycles, such as the one we've seen in 2013, is something that is very significant for emerging markets. And of course, there is the usual debate that was started by Raghu Rajan when he was the head of the Indian Bank, and Ben Bernanke, of whether this is something that ECB and the Fed must have in mind, or they should.
So thank you for the two international questions. And we didn't really talk about international when we were having our discussion. So I'm glad both the first questions did address that. I think it's actually an important issue. And the reason it's an important issue is because we're going to be tightening by historical standards quite quickly on both the balance sheet and the federal funds rate if things go as planned. And emerging markets, as was mentioned, already have difficult fiscal positions because they spent so much money addressing COVID. So having a very tight policy has implications, obviously, for exchange rates. And I do worry that if we start seeing cracks in financial markets, it's more likely to come from emerging markets than any other place. So I think that's something to keep our eyes on, because certainly COVID's not over, particularly in Asia. And the fragileness of their finances and the Fed tightening so quickly is going to put some real strain. So I think embedded in those questions, I think they are important questions. In terms of how much we think about international aspects when the Fed has their decision making, if you read the transcripts, there's always an international session that is part of the FOMC meeting. But if you actually read what each of the participants say, very rarely does anybody talk about international markets, either financial or economy. So it is a surprisingly domestically focused discussion. Now, part of that is that the US has the luxury because it's such a large economy, and because usually net exports don't drive economic results except for very particular cases. So by and large, the US has the luxury to do that when it's deciding its policy. And we are deciding the policy for the United States, so it doesn't get nearly as much weight. But I guess if you read the transcripts, one of the things that might surprise you is how little discussion of the rest of the world there is. I'm not saying that's right, but I'm saying that's the way it is and has been when I was sitting in those rooms. In terms of Ann's question, I do think that this is a different kind of inflation, and it does remind me a little bit more of the 70s in terms of a sequence of supply shocks. I mean, if you think of each of the various COVID strains being another supply shock, and that occurring at different times around the world, we really had a sequence of supply shocks that don't happen that frequently, and it really was a global problem. So when the Fed raises interest rates, it's affecting demand. It's not doing anything to changing the supply. But what it can do is reduce demand enough that you don't have as much price pressures as you otherwise would.
Yeah.
So I think the logic is that by raising rates and reducing demand for goods and services, you won't have as big a mismatch. And I do think that's the only tool the Fed has right now for addressing supply shocks. But the reality is it means that it's trying intentionally to slow down the economy, where supply again gets more consistently with demand. That's a difficult thing to do. The Fed knows how to tighten, but calibrating that exactly right is not a straightforward exercise. So I'll just stop with that. I think we may have time for one or two questions if there are.
Thank you. I got two real quick questions. One of them is very narrow. Economically, why do we care about the difference between runoff or selling of assets, especially unless except it allows you to be more aggressive as part of this? And the second one, much broader, but in some ways kind of following up on Eric's comment about, this, comments on the 70s kind of inflation. In some ways, the backdrop for what we've been going through here is in some ways probably something which is even more unusual in the sense that we had incredibly low inflation with at times very high growth, basically full employment. Why didn't we have inflation? Why were we having the struggle? And why were, in some ways, which is probably one of the reasons why we were at such low rates to begin with.
This is a relatively quick one. Just wondering what the participants think the correct monetary base at the moment is, because everyone sees these graphs of the treasury holdings, but no one really talks about the expansion of the monetary base and where that should be at the moment.
I'm also. Yeah, I'm gonna add a quick fourth one from the audience too.
I was just reflecting on the points a number of people have made. Is we've done QE in a big way twice because of the crisis, but when you think about it, we're terrible about getting out of it. I mean, after 2008, as soon as in 2015, 2016, somebody blows their nose and then the market reacts and everybody gets afraid and they won't do it. And now we've just done another big QE. Last summer, you're right, Eric. There was no reason to keep buying mortgage-backed securities. The housing market was going nuts. We were clearly at potential inflation, but we're unable to do it. And so I guess I'm concerned about the only reason we're cutting back on QE now is because we're in a crisis. And the question really is how come we're so bad at getting out of these QEs that we come into in such a terrible crisis? We should be able to gradually go away. Is it because the market reacts and then people get so spooked? Or is it because Congress can't do anything, so we decide it has to be on the Fed? It's just a terrible thing. And, Eric, I heard probably 3 or 4 governors last summer say we ought to cut back on mortgage-backed securities, not just reinvest it. Stop it. And of course, it was a compelling argument, but why was no one willing to do it? Just like we weren't willing in 2016 and 17 to stop doing it.
Well, I'm going to also add, when you answer, the Fed has talked a lot about both climate and diversity. Does any of this ever factor into these decisions when it really comes down to making the hard decisions? So do they care about distributional effects and do they care about climate effects?
2 minutes each. I'll finish up. Anyone want to start?
I can start. 2 minutes is hard, but I think to your last question, rightly or wrongly, central banks do have recency bias, just like all of us. And the fact remains that from 2008 to 2020, right, even as they did, 2008 made sense because remember, across 2008, right, the financial markets and the real economy were caught in the negative feedback loop. You needed someone to put a floor on asset prices. But QE2, QE3, if you remember, was about pushing up inflation expectations, and I never quite got that. But the fact remains that in Jan of 2020, the US unemployment rate was at 3.5%. Inflation was at 1.7. 5-year CPI swaps, so you look through the next 5 years through this cycle to the medium term, were implying core PC inflation over the medium term of below 2. And the Fed funds rate was at 1.75%. So if you put this in a statement, right, in Jan 2020, just before COVID, the financial markets were saying 175 was too high a Fed funds rate to consistently generate 2% core inflation in the US. Rightly or wrongly, that is where we're with full employment, with 3.5% employment. I meet the FOMC fairly regularly, and they never tell me anything. But they have recency bias. I think they just missed a trick across the second half of 2021 in particular. But I'll tell you, going into 2020, they were not worrying about their balance sheet being too large because they were looking at, they didn't have a counterfactual. They were, the thing you would worry about is, right, the balance sheet is large, it leads to bad things. And in a central bank, that bad thing ends up being inflation running out of control. After QE 1, 2, 3, that was just not true with a 3.5% unemployment rate. I think that colored their view, rightly or wrongly, far more than it should have across the second half of 21. As to why that didn't happen, which was the question, wages didn't take off. I mean, look at what is the usual cycle? The usual cycle is the economy expands about trend, unemployment rates keep dropping. Beyond a certain point, wage inflation picks up. At some point, it picks up non-linearly. Corporates pass those wage increases on to the real economy. Inflation goes up in the real economy. When it goes up beyond a point, the Fed says enough and tries to unwind that cycle. And that is a very, very difficult balancing act. That is the so-called soft landing. And usually you don't manage that and you end up causing a mild or not so mild recession, right? That last link never picked up. I remember, if I may, I remember having this conversation with Stan Fisher in September of 2015, just before he left. And it stayed in my mind. Even then, the US unemployment rate was at 5%. Okay, and I'm paraphrasing here, but he said, look, we get that something structurally has changed in global labor markets because 5 was still 2. Remember 2012, Chair Bernanke thought 6.5 was full employment, right? And then you had and he said, we realized that something structural has changed in global markets. And it was clear by then that the Fed's hiking cycle was starting and inflation was not anywhere close to 2. So why hike? And the answer was, and I am paraphrasing here, he said, the people in that room, I was outside the boardroom, have spent the last 40 years worshipping at the altar of U3. A 4 handle on the unemployment rate scares them. And, so they'll split the baby. They will hike in spite of inflation. That was the last hiking cycle. We never got to 2% on a sustained basis, but they will hike because of the jobless rate. And the way they will split that baby is by going much slower than the previous hiking cycle. And that, I think, just, it just mattered more than it should have.
Okay, I'll try to be very brief.
Sorry.
So first of all, on the issue of the monetary base, which is a narrow question, I think we're in uncharted territory now that we have these huge amounts of reserves and interest on reserves. So I think our old kind of textbook macro needs to be revisited. So I don't have an answer, but I love the question. I also think it's bizarre that an institution filled with well-trained economists like the Fed, who employs hundreds or thousands of us, doesn't see the symmetry between letting things run off and selling them. And that's just, kind of window dressing for the market. And it's crazy that they're not trying to educate people instead of kind of feeding into this weird asymmetry. And then Bob, I'm with you. I mean, I think we know what you're implying is that there's political pressures on the Fed, just like everything else. So as the proverbial, it's hard to pull back the punch bowl. And that's true of the balance sheet, and it's true of interest rates. There's always an asymmetry, which makes it hard for policymakers to say the party is over. And so, that's why I think they need to be more constrained in what they can do in the first place, because of that huge asymmetry that then can create a lot of problems that they can't really deal with.
Super fast as to monetary base. While we don't have enough time here, I think that after the first round of QE, there was a conversation of whether the balance sheet should be kept at 4.5 or brought down. I think that question out of the window. If you added up the fact that we're sitting at 9, if we reduce it even aggressively, so we are deemed to have a large balance sheet, but there is an interesting conversation around with several arguments in favor of a large balance sheet as a default, and parallels to Europe as a way of running monetary policy. And of course, the counter argument against that is always a political risk of the independence of the Fed. As to the why we talk, what is economical reasons for talking about runoff, I think that this is underpinned by whether you believe financial markets matter or not. And so to the degree that you do, and you are willing to this argument has been reiterated multiple times by me saying that financial markets are unstable, and we've seen examples like taper tantrum through 2013, 2019 volatility, then 2020 March, we are doubling balance sheet just to fix the market. So all of those seem to indicate that they seem to matter. And the other point was here, the race here, is that we don't know how to map those two things, the Fed rate movement and the policies that we're doing on the QT side. We don't know how to reconcile those, which is kind of gives us this uncertainty. And yet we seem to believe that it can tip off the financial market. If you believe in financial markets, then that's the connection for caring about the runoff.
I do think the Fed views the runoff a little different than selling assets. In part, runoff is a very passive strategy. So it's just what comes to reduces reserves. Once you start selling assets, you potentially could sell a lot more. So I think the market reaction is partly the uncertainty about how aggressive that sales would get is one of the things that people are concerned about. In terms of, it's been a weird period from the financial crisis to the pandemic. We had trouble getting inflation to 2%. So all our models started taking into account well-anchored expectations, which basically said it was really hard to get above 2% for any length of time. And I think that's one of the reasons why there was such a long delay on the QE, is that the Fed, both in its framework and in its modeling, probably assumed we were in the 2010 to 2019 world. And unfortunately, we were in the 2020 to 2022 world. And those were different worlds, and we were very slow to react. And I think partly it is the framework document that made us not adjust quite as quickly as we probably should have. In terms of the climate and diversity, one of the advantages of a low inflation rate is you can try to push the economy a bit harder to try to get up to 2%. And if you look at the framework document, we do talk about an inclusive economy. That was pretty controversial. I think it's still controversial. But the idea there is that those people that are last into the labor market tend to be helped the most by having really tight labor markets. Now, the other side of that coin is if you get it too tight and then have supply shocks, they're also the ones that are most likely to be laid off when you start raising rates. In terms of climate, it basically, if you look at the transcripts, it really doesn't come up in the FOMC meetings. Where it would come up is in supervision, and that's probably where it should come up, because the real risk to climate is if you can't get insurance for fires in California, you should think twice about what you're doing with businesses and consumers in fire-prone areas, or if you're locating in Miami in a flood zone, clearly a bank should be thinking about those kind of issues as well. So I think risk management is the logical place where the climate issues come to play. We're a little over time. I want to thank the audience for asking such good questions and thank the panel.
Join us, but these doors are going to open in a moment, so you can continue the discussion with the panelists. Do want to thank them, thank all of you for coming back in person. And again, the climate issues will come up at our next symposium, May 2nd. I'd like to thank all the people who helped put on this event. You see some of them in the back, including our excellent AV folks. Thank you, everyone.